Are you new to trading and want to avoid common mistakes? We've got you covered. Welcome to the world of trading, a place where fortunes can be made or lost with the click of a button. It's a thrilling high-stakes game that can reward those who play it well. But like any game, it comes with its own set of rules and pitfalls. That's why it's crucial to understand common mistakes that can derail your trading journey before it even begins. In the financial markets, knowledge is power. The more you know about the common mistakes, the better equipped you'll be to avoid them. But remember, avoiding mistakes isn't just about knowledge. It's also about mindset. It's about having the right attitude, the right approach, and above all, the right risk management system. So, are you ready to learn and grow? Are you ready to embark on a journey towards trading success? If so, let's dive into the top 10 mistakes every new trader makes. Mistake number 1, trading without a plan. Now, imagine setting off on a journey without a map or GPS. You're likely to get lost, right? The same logic applies to trading. Without a well-thought-out plan, you're essentially navigating the financial markets blindfolded. A trading plan is a set of rules that guide your trading decisions. It should detail your financial goals, risk tolerance, and specific strategies for entering and exiting trades. Think of it as your personal blueprint for success in the trading world. Trading without a plan often leads to impulsive decisions driven by emotions rather than logic. It's like gambling, where you're relying on luck instead of a strategic approach. And we all know how unpredictable Lady Luck can be, don't we? So before you dive headfirst into the markets, take a step back. Invest time in crafting a solid trading plan. It's your best defense against the unpredictability of the market. Remember, a trader without a plan is just a gambler. Moving on to mistake number 2, not using stop losses. Stop losses are like parachutes for your investments. They cushion the fall when a trade doesn't go your way. But some traders, especially new ones, shy away from them. They're optimistic, hoping their stocks will bounce back, and that's a dangerous game to play. Stop losses can help you control the amount you stand to lose on a trade. Without them, you're leaving your capital exposed to the market's volatility. Imagine you're on a ship in stormy seas. Stop losses are your lifeboats. You wouldn't sail without them, would you? And here's a tip. Set your stop losses at a level that your analysis and not your emotions dictate. This way you're making decisions based on logic, not fear or greed. Remember, in trading, it's not just about making profits. It's also about minimizing losses. Always protect your capital with stop losses. Mistake number 3 is overtrading. Now, we might think that the more we trade, the higher our chances of hitting it big. But in reality, overtrading can be a fast track to draining your trading account. Think of it this way. Each trade you make is like a ticket in a raffle. The more tickets you buy, the more chances you have of winning, right? But here's the catch. Each ticket costs money. And the cost can add up quickly, especially when you factor in trading fees and the potential for losses. Overtrading can also be a sign of an emotional response, such as fear or greed, rather than a thoughtful strategic decision. It's important to make sure each trade aligns with your trading plan and overall strategy. Remember, in trading, it's not about the quantity of trades, but the quality. Are your trades thought out, purposeful, and part of your larger trading strategy? If not, you might be falling into the trap of overtrading. Quality over quantity is the key in successful trading. The 4th mistake is ignoring risk management. Now, trading without risk management is like driving a car with no brakes. You might get somewhere fast, but the journey could end disastrously. Risk management is about preserving your trading capital. It's about surviving in the market long enough to become successful. Every trade you make carries risk, and successful traders understand this. They don't just focus on potential profits, they also consider the potential loss. They set realistic stop losses. They diversify their portfolio, and they never risk more than a small percentage of their account on a single trade. Ignoring risk management can lead to catastrophic losses. A single bad trade could wipe out your entire account if you're not careful. So don't fall into the trap of chasing big profits without considering the risks. Remember, the goal of trading isn't to make a fortune overnight, it's to make consistent profits over the long term. Risk management isn't optional in trading, it's essential. Mistake number 5, chasing losses. It's a scenario that's all too familiar for many traders. You've had a few bad trades, your account balance is dwindling, and panic sets in. You feel the need to make up for the loss quickly to get back to where you were. So you start trading more frequently or increasing your trade size, hoping for that one big win. But this is where the danger lies. Chasing losses can quickly spiral out of control, leading to even bigger losses. It's like trying to fill a hole by digging it deeper. It's a strategy driven by emotion, not by sound trading principles. It's a reactive approach, not a proactive one. Remember, trading is not about winning every single trade. It's about managing risk and making consistent, calculated decisions. Each trade is independent of the last. Don't let the results of previous trades influence your next move. Chasing losses is a slippery slope. Avoid it at all costs. Mistake number 6, letting emotions control your trading. We're all human and emotions are a natural part of our makeup. But when it comes to trading, emotions can be a real stumbling block. Fear, greed, excitement, and even the thrill of a win can lead you to make impulsive decisions that aren't grounded in sound strategy or analysis. Consider fear, for example. The fear of losing can make you hold on to a failing trade far longer than you should, hoping against hope that the tide will turn, or take greed. The desire for more can push you to risk too much on a single trade, leaving you exposed to unnecessary risk. Trading isn't about gut feelings or emotional highs and lows. It's about calculated decisions, informed by research and guided by a well-planned strategy. Remember, trading is a marathon, not a sprint. It's about consistency and discipline over the long haul. Trading is a game of logic, not emotions. Mistake number 7, neglecting market trends. As the saying goes, the trend is your friend until the end. It's one of the most fundamental truths in trading. Market trends essentially reflect the aggregated opinion and mood of all market participants. Ignoring these trends is akin to paddling against the current. You'll exhaust yourself and get nowhere. By following the trend, you're aligning yourself with the prevailing market sentiment. It's like riding a wave. You want to catch it at the right time to maximize your profits. On the flip side, trading against the trend can be a risky strategy, especially for beginners. It's like trying to catch a falling knife. Chances are you'll get hurt. Remember, trends exist on multiple time frames. A stock may be in a downtrend on a daily chart, but in an uptrend on a monthly chart. So it's crucial to analyze trends on various time frames before making a trading decision. The trend is your friend. Don't ignore it. Mistake number 8, overconfidence in early success. Picture this. You've just had a few winning trades in a row and you're feeling invincible. The market seems like a goldmine and you're certain you've cracked the code. But hold on. This is where overconfidence creeps in, and it's a slippery slope. You start taking bigger risks, throwing caution to the wind, and before you know it, you're making reckless decisions. Remember, in the world of trading, early success can be a double-edged sword. It can boost your confidence, yes, but it can also create an illusion of infallibility. The market has a way of humbling us all, and it doesn't discriminate between rookie traders and seasoned pros. So, celebrate your victories but stay grounded, keep a level head, follow your trading plan, and never stop learning. Early success is great, but don't let it cloud your judgment. Mistake number 9, lack of continuous learning. In the ever-evolving world of trading, stagnation is your worst enemy. Many new traders fall into the trap of complacency, thinking they've learned all there is to learn. This mindset can lead to missed opportunities and unanticipated losses. The market is a dynamic entity, constantly shifting and changing. It's crucial to stay on top of these changes. This means continually educating yourself about new strategies, trends, and market shifts. Successful traders know that learning is a lifelong process. They understand that to stay ahead, they must be willing to adapt and evolve their strategies. They invest time in learning about different asset classes, market trends, and financial news. They participate in webinars, read books, and engage in online trading communities. Remember, in this game, knowledge is power. The more you know, the better equipped you are to make informed decisions. So keep learning, keep growing, and keep adapting. In trading, you're either growing or you're losing. And finally, mistake number 10, not taking breaks. Just like any other profession, trading requires a well-rested mind to function at its peak. It's easy to get caught up in the whirlwind of the market's ups and downs, forgetting to step back and take a breather. But it's crucial to pause, refresh, and rejuvenate. Think of it this way. A car cannot run on an empty tank, and similarly, your brain cannot perform optimally without breaks. Breaks allow you to regain focus, reduce stress, and maintain mental clarity. They provide you with the opportunity to assess your trading strategy, celebrate your wins, learn from your losses, and plan your next move. Moreover, breaks prevent burnout, a common issue among traders. They help you maintain a healthy work-life balance, ensuring that trading doesn't consume your entire life. So it's not just about the numbers and charts. it's about your mental welfare too. Remember, even the best traders need to take a break. So there you have it, the top 10 mistakes every new trader makes. Let's take a moment to review. Trading without a plan, not using stop losses, overtrading, ignoring risk management, chasing losses, letting emotions control trading, neglecting market trends, overconfidence in early success, lack of continuous learning, and not taking breaks. Each of these missteps can lead to significant losses. But the good news is, they're all avoidable. With a well-structured plan, disciplined approach, and continuous learning, you can navigate the world of trading with more confidence and less risk. Remember, it's not about winning every single trade, but about making more right decisions than wrong ones over time. And most importantly, trading is as much about preserving capital as it is about making profits. So, keep these tips in mind, stay disciplined, and keep learning. And remember, even the most seasoned traders make mistakes. The key is to learn from them and keep improving. Thanks for tuning into Trading Titan TV. Please subscribe, like, and share this video if you found it helpful and informative.